Good morning, friends. Let's just wait for a minute for everyone to join in. And this place is already full. Valentine's Day, Friday morning, new income tax code, and Dinesh Kanabar. It doesn't get any better and bigger than that. It's a special Valentine's Day. It's a Valentine with the income tax bill 2025, and you almost. It almost feels like a Shah Rukh movie, where everyone has fallen in love with the new income tax bill, and it looks like that first crush, that love at first sight, all of that. But if you read the newspaper over the last 24 hours, all the articles, it's almost in symphony that the new tax code, the income tax bill 2025, is the best thing that's happened to India in the last few decades on the fiscal front. And therefore, at times you have to break that monotony, you have to break that consensus and have something contrarian. So to get started and be a little provocative, hopefully, that there were two objectives which the finance minister set out to achieve when she announced 6 months back that the income tax department would embark on this mission to revamp the Income Tax Act 1961. What were the two objectives? Simplicity and reducing litigation. And 622 pages, 536 sections. And I've had a chance to go through some of them, not all of them, but I have, trust me, if people think that is a simple tax code, I have a bridge below Lower Parel to sell. And in terms of reducing litigation, there are at least a few areas, big ticket areas, where I thought that this bill would kill litigation. The answer, to many people's dismay, but to lawyers and Dinesh Bhai's delight, the answer is no. It doesn't kill any of those litigations. But does that mean we have nothing to do? Absolutely not. We have a lot to do. The sections have been rearranged in many places. There are some places where I even noticed that syllables like and the have been added. Maybe some commas have been added. We all know that the word irrespective has come into play. So much more. When you have a new code, even assuming that this bill is the income tax version of the BNS or the new criminal laws, we still have a lot of sections, a lot of, if not concepts, but a lot of provisions to go through. And for that, we have an array of experts from Dhruva Advisors in the next 60 minutes. Dinesh Bhai's keynote, followed by a senior partner, Umesh Gala, who will take us through some of the analysis. And then he'll hand it over to Abhishek Mundra, who will take us through the remaining provisions of the Income Tax Bill 2025. Remember that I think the one doubt we had, whether this bill will be passed in this session or the next session. The finance minister said she's expecting or urging the select committee to give a report by the first day of the next session. The next session technically is monsoon because the House has only broken for recess in the budget session and will reconvene on March 10. Monsoon session is still a few months away, and Times of India has confirmed today that the bill is expected to pass in the monsoon session. So we still have time. Not for amendments, I don't think there is scope for much, but we have time to gear up, to be prepared when the new bill is enacted very, very soon. We are just a few months away from that. That's a given. But on that note, I hand it over. I know we all are wanting to hear from the man himself. He's among the most renowned tax experts in Asia, Mr. Dinesh Kanabar, CEO of Dhruva Advisors. Dinesh Bhai's keynote, followed by Umesh Bhai and Abhishek's analysis, and a lot of questions. Type in your questions in the Q&A box, and we'll take as many of them as possible. Today, time is not a constraint. Welcome to Income Tax Bill 2025.
Morning, Arun, and I'm delighted to see that we already have a full house of people participating. Morning, everybody. As Arun rightly mentioned, this is a great time to really thank your Valentine. And here we are, all tax folks, looking at the income tax bill, which is the nature of the beast. The finance minister, in her budget speech, said she was introducing the new income tax bill. It took a week more than what we thought she would do because it was expected to come week before the last. It has been introduced as a money bill and therefore is likely to get enacted very, very soon. So if I may dare say so, I don't think the select committee to whom this will be referred will have a lot of time to invite suggestions and sort of make recommendations or changes. So I would expect that the changes between the bill and the final act are going to be de minimis. It's to come from in effect from 1st April 2026, and therefore will apply from financial year 26-27. We now got to get familiar with the terms financial year and tax year as opposed to previous year and assessment year. The current law was enacted at a point of time when the government's priorities were very different. And I'm not making any qualitative comment here. I'm just saying they were different. Right, wrong, doesn't matter. And the priorities earlier were to promote a particular line of business, a particular geographical area, a particular trade. So you had deductions for fisheries and for export income and for hotels and things like that. And then over a period of time, SEZs came in, etc., etc. And then came a philosophy that business should be done on the basis of economics and not on the basis of tax incentives. And therefore, we had the movement from the old tax regime to the new tax regime. So here we were looking at a law which had 819 sections, 47 chapters, schedules, and all of those, much of it had got redundant. And we'll talk about it as we go along. And therefore, we are looking at the new bill which has been presented. Abhishek, if you could go to the next slide. And we are looking at one level at a continuation of the tax law. So what has been done is that all the redundant sections, the ATHHCs and Ds and whatever else has gone away. Provisos, explanations have been removed. There is a comprehensive simplification of many things, including non-profit organization, exemption, etc. And as I said, that here we looked at the new tax regime for corporates. To my mind, almost 80% of the corporates have now moved to the new tax regime. Nobody wants to avail of deductions and exemptions, which in any case get litigated. Individuals, after the Finance Bill 2024, are again very, very likely to move to the new tax regime, and therefore they are also not likely to look at deductions and exemptions. And therefore, it was just almost inevitable, if I may say so, that we needed a new tax code which would move towards the simplified tax law. And that is what this bill is trying to do. The provisions which were scattered, so you could find, for example, going back to non-profit organizations, provisions all across section 10, 11, whatever, now they've all been put together, business trust, etc. So the reading becomes fairly straightforward, comprehensive. We also have number of charts and number of tables. So I'm told there are almost 57 tables out there, which summarizes provisions like TDS at one place. Again, very, very welcome. And elimination of redundant provisions. Abhishek, if you can. So at one level, I'm very happy that there are not too many substantive changes because it has taken decades for the law to settle down. Had we got a completely new code, we would have looked at a new set of issues. I always tell my team that if you have a totally new tax code, a tax expert and a novice are at par because they're now reading for the first time the same thing. That's not what has happened. The law continues to be the same. And I wish that few of the things that we are all hoping for, but which are not there in the bill, happens over a period of time. So as Arun mentioned, we are looking at unchained dispute resolution litigation system. We are all aware, for example, how it takes almost 5 to 6 years for a matter to go from an assessing officer past the commissioner appeals, in which point of time you end up litigating for that 20% tax. The department does not get the taxes which it might legitimately be entitled to, and a taxpayer is out by that 20%, which he believes is a burden on his thing. The There are a number of suggestions with regard to compliance simplification, TDS provisions, etc. None of that has happened. A number of suggestions were made with regard to business restructuring. Those have not been taken into account. And there is no roadmap as yet on BEPS, which is understandable because we don't know where is US standing on this and whether and how much will this take place. But one was still hoping that there will be some roadmap on BEPS and where does India stand. That has not happened. What that therefore means is that we have a simple law, a more structured codified law. But maybe over the next 2 or 3 years, we will still see amendments which hopefully will address some of these issues, dispute resolution, which I think is one of the biggest things and which is one of the biggest barriers to ease of doing business. Compliance has become such a big thing for corporates, a huge cost, and one is hoping that this again will be addressed in due course. So a lot done, but miles to go before we sleep, as we famously say. And with that sort of broad analysis, we will now look at the specific provisions. I can tell you that some of the changes, while they may appear simple, are likely to be probably resulting in far more litigation, different sorts of litigation, because any change in law can never be done just by people sitting in North Block. We have interpretation issues and the likes of it. And I will now hand over to Umesh and thereafter to Abhishek to take us through the minutiae of the changes that have happened. Over to you, Umesh. Thank you.
The best takeaway as far as the new bill is concerned is that I believe this is templatized in terms of how the an economic legislation ought to be. So most of the deductions, exemptions, they have all been moved into either schedules or in terms of tables. So as a template, I believe this is a good template to start with. In the last since independence, amongst the economic legislations, we've seen FERA becoming FEMA. We've seen Companies Act being overhauled, and this is a major tax law which is being sought to be overhauled. And therefore, I think the expectations that were riding were very high. As a tax practitioner or as a taxpayer, I think one of the key things that one ought to be aware of and possibly is how does the jurisprudence move? Because I think it takes years and decades for any law to get settled. And with Income Tax Act, we are never sure whether the law is settled. But Income Tax 61 now moves to a new bill, hopefully an act sometime in future. And therefore, a lot of litigation that we have seen in the past in terms of Dinesh mentioned about all the explanations and provisos getting eliminated. And there has been a mountain of litigation in terms of how explanations are understood under the tax framework, how provisos are understood, and all of this is past us. And therefore, you have most of the explanations and the provisos being converted into specific sections or specific subsections or points in a section, and therefore how the judiciary will look at all of this is an important yardstick to keep in mind. I think we will have, Arun has already said we'll take a few questions, but I think without much ado, I'll ask Abhishek to take us through the specific provisions.
Thanks, Umesh. Thanks. So while we discussed about in terms of how the new law has been codified to appear it to be simplistic and in a very lucid manner to read into, but still these are tax laws and each and every word needs to be interpreted, given due weightage as there is no principle of equity to start with from an interpretation of a tax laws. And that's what while we scrutinize in terms of each and every aspects of the language change that have happened, there have been certain nuances or criticalities which have arisen as compared to what we have reading in terms of the existing tax law which is there. And we start with those aspects from a business profits perspective. So under the current provision, if there is an existing domestic company which is into new regime, one of the aspects was that there will be no deduction in terms of the exemptions or the specific deductions which are there. But there was a carve out in terms of one aspect of if there are intercorporate dividends which are being given at multiple level. So a benefit of section 80M was provided so as to avoid any cascading effect of the dividend taxability on upstreaming of those at the multiple layers. And even if the company was paying taxes as per the new regime, still this benefit was available in terms of granting deduction on the multiple level tax dividend which has been declared. This specifically, the deduction for ATM, the equivalent provision, has been excluded from the provisions under the new bill, meaning that even if we are into the new tax regime under the 22%, any dividend which gets paid upstream at each level, it would get taxed as such. So therefore, this would be in a sense a double taxability for any upstreaming of dividend income that is happening. Interestingly, the similar provisions are there for other concessional tax regimes, say new manufacturing companies which are under the 15% tax regime. And there also the benefit of ATM was provided. That benefit continues under the new income tax bill for the new manufacturing company as such. So this seems to be a differential in terms of the treatment which is provided for the concessional tax regime as undertaken by the new companies under the manufacturing or for the existing company which is there. Whether this is an oversight or an intentional, that is one which further clarity would be required. But as things stands today, this is an issue for the existing domestic company claiming concessional tax regime under section 22. Now, from an R&D expenditure perspective, and again, this would be relevant only if the companies are paying taxes as per the old regime and not as per the new regime, because under the new regime, there is no weighted deduction from an R&D perspective. So today, if a company is entered into R&D expenditure, there are two deductions. One for an in-house R&D, which is not approved by the regulatory authority, and one which is regulatory authority, the approval is granted. There is not much of a difference today because both are at par in terms of granting 100% of the deduction, including for eligible capital expenditure, which is there. But the way the new provisions have been drafted, it is appearing that any R&D expenditure, which also include any eligible capital expenditure, the deduction would be provided only if the R&D facility is approved. So the ability to claim for unapproved oblique in-house R&D expenditure, which was on a basis of self-assessment, which was there, that has done away with, and every R&D expenditure, and especially the critical aspect here is from the perspective of claiming 100% of the eligible capital expenditure will be allowed only if the R&D facility is an approved facility. Again, from the perspective of what we mean by eligible capital expenditure, the cost of land and building is not covered by that. Here again, under the existing regime, for an unapproved R&D facility, the way the provisions have been drafted, there were ability to claim capital expenditure for cost of building as well. But that has now done away with, given that there is a specific mention about non-inclusion of cost of land and building so far as the R&D facility is an approved facility. Certain tweaks in terms of the presumptive taxation, both as it is applicable for the non-resident taxpayers as well as for the resident taxpayers. Today, there are various businesses in terms of shipping or services provided for the oil and exploration businesses or turnkey projects where the presumptive taxation regime has been provided. And in the recently introduced finance bill 2025, they have added one more business in terms of any services or technology provided by the non-resident for the purpose of new electronic manufacturing facility, which is there. But out of these businesses where the presumptive taxation were there were only two sectors for the mineral oil as well as for the turnkey, where the ability of the non-taxpayers were there to show lower profits as compared to the presumptive rate that has been prescribed by providing by having audited books of account and everything. They have not just streamlined this provision so as to provide the ability to offer lower income than the presumptive tax rate for all the sectors except one, so long as the audited accounts are being maintained by them. So therefore, this has now been extended to even shipping and aircraft business, which are under presumptive scheme, if they believe that their profitability actually is less than the presumptive tax rate by maintaining books of accounts and audited. But This has not been extended to the newly introduced presumptive tax regime for the electronic manufacturing facility, and there they will continue to pay the presumptive tax rate of 25%, presumptive income of 25%, where the effective tax rates would still be less than 10%. Even firms which are eligible for the presumptive tax rates in terms of the prescribed threshold turnover limits which are there, or from the perspective of any professional services, they have now brought in a clarification to say that while arriving at the taxable income, they would have the ability to claim deduction of any interest and remuneration which is paid to the partners, which are actually taxable in the hands of the partners as a deduction for the purpose of computation of the presumptive tax income. Now, this is also from a royalty perspective, which will, in a sense, have an impact while making payment of royalty to a non-resident. So under the current provision, any payment of a royalty to a non-resident is deemed to accrue or arise in India when the payer is the resident. And there is an exception to state that if that royalty income, which is arising from property, information, etc., and used for the purpose of any overseas business or for earning any source outside India, that is not considered as a taxable royalty in the hands of the non-resident. They have, so therefore, it was restricted only in terms of royalty payment pertaining to property, information, and rights which are there. Now they have done away with this language, and which entails that now any royalty arising on account of any aspect which is defined as a royalty as per the provisions of the Act, and which is utilized by the resident payer in terms of his business outside India or for earning any source outside India, that would not be treated as a taxable royalty insofar as non-resident is concerned. And therefore, there is no need to resort to the treaty provision as well in that sense. So it's a welcome clarification which is there to be made applicable to all payments of royalty. In same breath, and this appears to be maybe a drafting oversight also, if any royalty is paid by a non-resident to another non-resident for the purpose of earning any source of income in India or for the purpose of carrying on any business in India, that royalty is taxable, even though it is paid between two non-residents, given that the business is carried out in India or the source is in India. While they have retained the taxability so far as the business is carried out in India, however, when it is pertaining to any source which is other than business, they have used the term where the source is outside India, as compared to mentioning that the source is in India, meaning that today, if there is any payment of a non-resident to non-resident royalty, it would be taxable in India only if it is utilized for the purpose of having a source of income in India. But under the proposed language, any payment of royalty by a non-resident to non-resident, even if it is for the purpose of earning of any income for a source outside India, that would get taxable. This seems to be an anomaly, and maybe appropriate representation to be made, or the select committee may be considered to look into this to course correct this anomaly so as to have the royalty only taxable where the non-resident's source of income is in India. Any income tax paid today, it's not allowed as a deduction under the provisions of while computing the business and profits regulation. But currently the word used is that any income tax paid on any income which is chargeable under the head business and profession. And hence a view was taken that if tax is paid on sources on income which is other than business, that would not be covered under the provisions of disallowance under section 40, which is there. But they have course corrected it to say that any income tax paid on any income will not be allowed as a business deduction for the purpose of computing the taxable income. But here again, there is one thing is that they have not touched anything in respect of any taxes paid overseas in the foreign country for which the foreign tax credit is not available. So if there is no foreign tax credit available, there is no specific disallowance of that taxability while computing the profit income under the head profits and income from business and professions. One of the aspects which is the 43B payments, where the deduction is allowed only on payment basis, irrespective of the method of accounting followed or irrespective where the liability arises. And there was always a debate that while it includes tax, cesses, and light payment which are there, whether surcharge, if paid, would also be get covered as a part of disallowance under 43B on payment basis. And there have been Supreme Court decisions also to held that surcharge cannot have the characteristics of the tax, and the decisions were on either side. But that was the prevailing view or a legal view which was taken, that surcharge is not specifically covered under the tax, and hence the ambiguity whether the deduction of the same would be allowed on payment basis or on accrual basis. But they have put to rest this anomaly, and they have specifically included the term surcharge so as to be allowed as a deduction only on payment basis and not on accrual basis. Similarly, under the MAT provisions, they have consolidated the MAT which is applicable for the companies and AMT which is applicable for the LLPs, which essentially are there under the old regime. And one of the aspect which was there, which was pertinent to MAT credit, that if there is a conversion of a company having a MAT credit into an LLP, then LLP was not required to, LLP was not eligible to claim that MAT credit while discharging its tax liability. Given that they have consolidated the entire tax regime of MAT, including MAT credit under a single code, which was earlier spanned across 4 to 5 multiple sections. And there is a specific provision which is mentioned that if any company is getting converted into an LLP, the provision of this entire section is not applicable, which means that the LLP also will not be subject to an AMT if it is converted if it has been coming into existence upon conversion into company. Again, this seems to be a drafting oversight where the intention would have been to not allow the benefit of MAT credit upon the conversion, which is specifically mentioned under subsection 13 of the respective provision, as compared to mentioning that the entire provision of the section will not be applicable. Yes, Umesh, yeah.
Yeah, sorry. Couple of comments on the profits and gains of business. I think that the biggest worry for taxpayers would have been continuity of the computation and the chargeability mechanism for business and profits, because that continuity remains. Therefore, there is no major tinkering, no bad news is good news is how the markets and everyone is reacting to this new income tax bill. One small provision which is important, that depreciation which hitherto was treated as an allowance is now termed as a deduction, and therefore for certain aspects of the law, because depreciation is treated as a deduction, maybe a 14-year disallowance, which was there earlier. There were case laws to say that 14-year disallowance would not apply to depreciation. So some things could change because depreciation now is a deduction.
Yeah. Now, moving on from capital gains and mergers and acquisition, nothing in that sense substantial which has come structurally as such, but we'll discuss few of the nuances based on the language interpretation which is there. Under the existing provision, a demerger is treated as a tax neutral if it is undertaken under the NCLT code process, and there the reference was for the 1956 Act provision, which they have course corrected it to give the reference to section 232, which is there. But the critical aspect here is that demerger can also be undertaken under the fast track process under the corporate law provisions, which need not be governed under the NCLT process, and which is governed under the separate legislation by section 233, which is there. Now, since there is no reference of section 233 for undertaking the demerger, whether that would be treated as a non-tax neutral demerger, that is something one needs to look into. Just to draw an analogy, that even under the current Act, where the reference to the provisions were of 1956 Act, and then to any demerger happening under the company law provision were considered to be a tax neutral if the respective conditions were satisfied. The same analogy can be extended further even for undertaking demerger under the fast track process under section 233, even though there is no specific reference. But yes, that's the call which one needs to take. One of the important in terms of the way the long-term capital gains tax rate is applicable for non-residents which are selling shares of or debentures of an Indian company. It is mentioned that the tax rate is now at 12.5%, which is there. But when we consider for a non-resident, especially when they are invested and selling the shares or debentures of an Indian company, their capital gains working is computed after factoring the forex difference. And that computation mechanism has not changed. It has been extended, or it has been also considered even under the new bill for computation of the capital gains for the non-residents after factoring the forex difference which is there. So therefore, the taxability of the non-resident, which is at 12.5%, needs to be computed on the capital gains, which has been arrived at basis the computation mechanism provision, which could also factor the foreign currency aspect as well. Another important aspect, and if we see the finance bill or finance act of the last year, where they radically rationalized the capital gains tax rate from 20% to 12.5%, there was a cutoff date which was applicable. So if any transfer is happening before 23 July 2024, the tax rate of 20% or 10% depending upon the asset category were applicable, and any transfer happening after 23 July 2024, the tax rate of 12.5% were there. Under the new bill, they have done away with the reference to the cutoff date of 23 July 2024, and it's read plain vanilla that capital gains to the non-resident would be, or capital gains would be taxable at 12.5%. Now, it has an implications on some of the aspects, like if the transfer have happened before 23 July 2024, but the taxability of arises later, say on a receipt basis or on happening of any specific incident. So if there is an enhanced compensation received, the taxability arises when the enhanced compensation is received, which is maybe say in the today's date after 23rd of July 2024. Or if there is a conversion of an capital asset into stock in trade, while the transfer happens on the date of conversion, the discharge of the capital gains happens only when the corresponding item is sold, which could happen after 23rd July 2024. And hence, since the cutoff date reference has not been there and the charge is there on the subsequent event, the taxability of this would be then under 12.5%.
Yeah, just a small point. Possibly, the way this old capital gains rate versus new capital gains applies. I think possibly the thinking of the government was that July 23 was a cutoff for that transitional year, and therefore once we move into years after 24, 25, it is the 12.5% rate that is applicable, and possibly that's how the thinking of the government seems to be, and therefore this while appears to be a change, but in my view, this could be how we should look at the law for future.
Sure, and one more area, and which in a sense is a debate in terms of taxability of a contingent deferred consideration in respect of various transactions, where consideration is contingent and one may not know, and there have been an issue or interpretation issue in terms of in which year it would be taxable. Courts have taken an interpretation since it's a contingent, it is not accrued, and hence the taxability arises only on receipt basis. So in this situation, whether one would be able to take a benefit of the 12.5%, given that the charge is arising only on receipt basis today, and there is no reference for the cutoff date of transfer of 23rd July 2024. That is, I think, one of the another area which it would have an impact. There is a huge debate in terms of there are various deeming provisions under the capital gain tax provision that even if the period of holding of a capital asset has been more than 3 years and which categorizes as a long term, but because of the deeming fixation, any capital gains arising on the transfer of those assets are treated as a capital gains on the transfer of a short term asset. The classic example is on the depreciable asset or on the non-convertible debentures or the unlisted debentures and bonds which are there. That even though the period of holding would categorize it as a long-term asset, but for the purpose because of the deeming fiction, it would be treated as a gain from the short-term capital asset. Now, the ramification of it is that the deeming fiction is restricted in terms of for the provision which is there, and it cannot be extended for other provision. Say, for example, for claiming capital gains tax exemption if any corresponding investment has been made, or for the purpose of claiming of the tax loss. In that course, the court have held, and based on the language which is there, that since deeming fiction has to be restricted for the purpose what it is meant, it was given a benefit of capital gains tax exemption, say under section 54 or 54 EC, if the asset per se was the long-term capital asset. Now, what the change that have been made, especially in the equivalent of the 54 and 54 EC, that the gain has to be assessed as long-term capital gains, irrespective of whether it is a short-term asset or a long-term asset which is there. And hence, since because of the diminution, the gain is charged to tax as short-term capital gains, there will not be any ability to claim deduction exemption under section 54 and 54 EC equivalent. But they have not brought these changes standardized uniformly across the provisions. So there are still certain provisions. So from the perspective of losses, or if capital gains tax exemption is to be considered from a 54F perspective, meaning thereby that if any sale of asset which is inherently long term, but the investment is made in a 54F like exemption, those exemptions still should be available. There was a recent special bench decision again on this controversy of applicability of the tax rate, whether the tax rate of long term should be applicable or the short term, and where again the special bench has held that the diminution have to be restricted for the purpose of computing the gains as per those provisions, and it cannot be extended to tax rate which is there. Now, given the fact that you have clarified that the gains would be treated as short-term capital gains and not as a gain from the short-term capital asset, maybe this controversy to the extent of NCDs will put to rest, and it would be subject to tax at the rate applicable for the short-term capital gains. The another, again, whether it's a purposeful or intentional or a drafting oversight, that for a rollover capital gains exemption, that if you invest any proceeds from a transfer of a long-term capital asset other than land and building into another immovable property where you have existing one property and you invest in one more property, the entire consideration that was invested would be claimed as a capital gains exemption, and no capital gains would have been applicable therein. But there was a restrictions to say that if after buying the new property, you purchase another property within a period of 1 year, then the eligibility to claim capital gains exemption would have gone. Now they have extended that period of restriction from 1 year to 2 years, meaning that after having purchased new capital asset immovable property and claimed exemption, if you try to purchase one more property within a period of 2 years, then the capital gains exemption which was claimed would be ineligible to be claimed as such. Now, from a perspective of crypto assets, which is defined under the term VDA, which has been there, there is a specific tax regime which is already provided, which continues to be there even under the income tax bill. But one important aspect that in any transactions, we will need to obtain tax NOC if there are any existing liability before the transfer takes place, which is done under section 281. Now, it had a far-reaching impact that if such NOC is not taken, the tax authority had the ability to determine the entire transaction as a void transaction, and were able to claim the recovery proceedings which is there. One asset category which has been included is now VDA. So if any person intends to transfer a VDA as an asset and has an existing income tax liability, before making that transfer, it needs to obtain tax NOC from the department. And if not done, the ability of the buyer to claim that asset would be doubtful if the department considers this transaction as a void. So again, having a far-reaching impact in terms of anyone thinking to transfer VDA and not obtaining the tax NOC, which could potentially jeopardize the ability from a buyer's perspective. From a financial services sector, especially under the IFSC, there was one interpretation issue that the tax holiday which is available for the IFSC unit is applicable only from the services rendered to another unit in an IFSC. And that was creating an interpretation issue. But now they have clarified that any eligible IFSC unit which is entitled for tax holiday would be entitled to claim tax holiday for all the business activities which is undertaken by it and as approved by the authority which is there. So it's a welcome move and creating a lot of interpretational issue which was hitherto there. The government has been providing the from an overseas fund perspective to encourage them to set up shop at the India level and granting them the tax exemption if there is a migration or relocation of the overseas fund into the Indian fund. And there the cutoff date was March 25, which got extended to March 2030 in the Finance Bill 2025 as such. But in the new income tax bill, the date continues to remain as March 25, and this seems to be an oversight on the draft, which could get course corrected. Another important aspect, from an AIF perspective, category 1 and 2 are provided a pass-through status, meaning they are exempt from the taxability and the investors of the AIF units are required to pay tax. But that pass-through status is not there for AIF 3. But the way the definition of the AIF, which is providing the pass-through status, is there, it creates an anomaly or an interpretation issue to states that the pass-through status is there for all the categories of AIF and not only restricted to AIF 1 and 2. And this we are saying is that today it is categorically mentioned that any AIF 1 and 2 regulated by SEBI or under the IFSC, both would get the pass-through status. But the way the definition has come, it seems that only AIF which is regulated by SEBI and any fund which is set up in the IFSC will get the pass-through status. So even in respect of AIF 3, which is set up as an pass-through AIF fund which is in the IFSC, there seems to be an interpretation issue that the pass-through status would be accorded to AIF 3 as well, and it would be not be taxable at the AIF 3. Again, this will have an impact in terms of the interpretation of the tax treaty. Today, if any term is used in the tax treaty but not defined under the treaty itself, there is an enabling provision under the treaty as also under section 90 that if that term is defined under the provisions of the act, or if government issues any notification explaining the meaning of that term, then that meaning have to be accorded while interpreting the taxability on any transaction. This has now been extended to state that if a term is mentioned in the treaty and the same is not defined under the act or through any notification, but it is defined under any other tax clause, say GST or any other law of the central government, then the meaning of that can be accorded. Obviously, unless the context otherwise treated to be different, then that need not be considered. But then those meaning can be directly imported while interpreting the provisions of the treaty which is there. And this is made applicable from the date of the respective treaties coming into force, which means it's have a retrospective applicability. Now it has haven't far-reaching implications. The government in its FAQ have stated that this is in line with the industry, in line with the international tax commentary practice, so as to import the meaning even if it is not defined under the Tax Act. However, if one sees Article 3(2), the ability to resort to the meaning of the term is in a sense restricted only to the term used under the tax laws, specifically as governed under the treaty as such. Whether by extending a resort to another laws will be in compliance with the provisions of Article 3(2), that is something which would come as a legal interpretation issue and for the courts to determine. Second thing, and one we have seen is from an MFN judicial perspective, especially when the tax authorities and as validated by Supreme Court that the decree which is provided under the other jurisdiction, say Netherlands, it's an unilateral act and cannot be resorted to while interpreting the provisions of the act. Now, in reciprocation, any amendment which are done and which is done by virtue of a notification or trying to resort to the other laws, can this be also be treated as a unilateral act and may not be therefore considered for the purpose of interpreting the provisions of treaty as were entered into at a prior date. So it's the classic statute versus ambulatory approach which will come into play here as well. Another point is that even under the Indian jurisprudence, Supreme Courts have held that you cannot just uplift the meaning of a term from any other fiscal law. So while interpreting the term of Income Tax Act, if that defined under the GST law, the Supreme Courts and the courts have held that cannot be uplifted directly, and one needs to see the context because the context of both the fiscal laws are different as such. So in that context, how the interpretation of the term, unless the context otherwise, which is a subjective interpretation that one needs to be one needs to factor in while determining the taxability of any aspects.
So this, Abhishek, is a potential point which will raise eyebrows, especially for non-residents. And I hope before the select committee, I think if we are able to persuade and see that you can't expand terms not defined under the treaty to cover, terms defined under any other central law. It could be very nightmarish situation for a non-resident who's trying to grapple with the laws of India.
Absolutely, Umesh, absolutely. Yeah. Another important and which will have a far-reaching impact on the interpretation of the transfer pricing provisions. So today, while determining the associate enterprise relationship, which is covered under 92A1 and 2, it is provided that only where the threshold limits as provided to determine the A relationship which is there, only that needs to be considered to see whether there is a A relationship. And if the threshold limits are not been fulfilled, one cannot resort to the de facto or the general provisions under 92A1. This was coming out from the memorandum which explained the provisions to say that one only 92A subsection 2, which provides the threshold limits, only explains what is meant as a de facto control under 92A1. Courts have taken divergent views, but by and large, the legal view which was emerging is that only if the objective threshold conditions are satisfied, then only the A relationship comes into existence. And we have brought in the difference in the language under the new and under the existing and the new provisions, where it is mentioned that without affecting the generality of the provisions of subsection 1, which means or comes to an interpretation to say that while objective thresholds are there to be satisfied, but also one needs to consider the subjective test of the de facto control to see whether the A relationship exists or not, and which is in a sense a divergent legal view from what has been an interpretation under the existing provision. The government has been looking into in terms of simplifying the tax provisions so as to mitigate any interpretation issue or provide any mitigation of any potential tax litigation which could arise. Now, given that there is a need to interpret a subjective provision will lead to the differentiation in the interpretation and hence a potential litigation matter as well. And given that it's a transfer pricing, it will have a far-reaching impact on all the cross-border transaction to determine now the AE relationship on the de facto control as well.
Again, I think Abhishek, this is a point which one expects that before the bill gets converted into law is set right, because having objective criteria possibly is the only way to give effect to the provisions, and having a subjective, because even if you participate by holding 1%, it is participation in the capital, and that will make the provision unworkable.
And even under the objective test, they have the ability to increase any number of transactions because there is a residual category which is there. So they could have actually enacted and gave more clarity on that. There's some tweak in the arm's length computation in terms of whether one comparable is used or multiple comparable, and the safe harbor limits of 3% or arithmetic mean which is there. And there was an issue whether these are applicable only if there is a one comparable or a multiple comparable. So from a plus or minus 3%, it has been clarified that it would be applicable for only one comparable. If it is multiple comparable, they will come out with a pricing mechanism of the same. And also from an arithmetic mean perspective, it has been completely deleted now. So therefore, in a multiple comparable, one needs to see what's the pricing mechanism now comes into picture to see whether both these aspects are taken care of. There was a huge expectations that the TDS provisions would be rationalized. And when we say rationalized is that not in terms of a threshold limit or the rate correction or standardization, but in terms of consolidations of various payments which are made. And the expectation was that it should be done in three payments: the salary payments, one which is specific like winnings or lottery, and the third category which will include all other payments, and there could be standardization of rate on that. But that has not happened in the finance bill, as also it has not happened in the current income tax bill. But the way they have consolidated or rationalized the provision is that instead of going through multiple sections, they have divided it into the broad categories qua the nature of the pay or qua the nature of the payment which is there. So now all payments to a resident, and which is, we are talking about the non-salary payments, it is coming under one provisions which is given in the tabular form. Then the second is for all payments to the non-resident. This comes under the another category. Then there are specific aspects where it have listed down that TDS will not be applicable. And these are like where threshold limits are not made, or where there is a pass-through status which is there. So intermediary payments will not be subjected to TDS for payment to business trust and all. So it has been listed down under this category that TDS will not be applicable. And specific transactions, which is winnings of lotteries and all, that has been carved out, which is there. So the simplistic aspect is that for any payment to a resident, one only needs to a table and to see where the categorization of the payment falls as compared to locating it under different provisions of the Act. No structural changes in the TCS provisions, and those remains as it is.
So on the TDS, while the expectation of rationalization of the rates has not happened, but I think because the template is set, one can still be hopeful that over the next 2-3 years we should see some more rationalization, especially because the government is mindful about bringing down the compliance and improving the ease of doing business.
Today, if any application was to be made for a lower withholding tax, given that taxability is not there, or it is not subject to tax at all because of losses, there were only specific provisions under which one could have approached the tax officer for seeking for nil or the lower withholding certificate. Now that specific reference to specific sections under which only you can make an application has been done away with, which means that if anyone believes that there is no liability to have the TDS at the prescribed rate, but it should be at the lower rate, then anyone can approach the tax officer for the purpose of seeking lower tax withholding certificate. Under the current provisions, there was a specific reference that the application can be made and the tax officer can issue either nil or lower withholding certificate. The reference to nil TDS certificate has been removed, but they have continued to maintain it as a lower rate. One may say that a nil and lower, in a sense, would have just created a confusion, and they have just standardized it to mean lower, which would also mean nil as well. But now whether the tax authority will consider it to say that since the reference to nil has gone by, therefore there will not be any ability to issue nil tax withholding certificate, is something again would become an interpretation issue. Under the current provisions, there was no mechanism provided for the cancellation of a lower withholding certificate. It was just mentioned in the certificate so issued that the assessing officer has the authority to cancel the certificate. But now they have brought it codified under the law that it can be done only after giving a reasonable opportunity of hearing. There has been a standardization in terms of providing the threshold limits for the purpose of passing either the TDS or the TCS order, where the department believes that there is a short or no withholding tax which is there. And now that time limit has been standardized to 6 years from the tax year, which is the prevailing financial year in which the transaction has arisen. One more aspect, which is that from an ESOP tax perspective, especially under the startup sector, there was a time limit provided of 48 months from the date of grant of ESOP or the sale, which time limit has now been extended from 48 months to 60 months, which is now a very welcome provision. In terms of the rationalization of the assessment provisions, so today one can claim tax refund by filing the tax return, which was not restricted to filing it before the original due date. But they have brought in a specific amendment under the law, under the new bill, to state that the refund can be claimed only if the tax return is filed within the original due date.
I think again an area where I think we need to represent, because denying refund if the return is not filed within time limit could be very burdensome for assessees.
Absolutely. There have been instances where, while the return got processed under the 143(1) intimation, if there is a mismatch in the Form 26AS and what got offered in the tax return, and it was creating a hell lot of issues for various taxpayers in terms of explaining as to why those reconciliation has been there, especially at the 143(1) intimation level, which clause they have now removed it, and therefore the expectation is that any anomaly of that should not come as a part of an adjustment while processing the return, and those could be taken up at the time of the scrutiny assessment. From a reassessment perspective, procedurally, nothing substantially has changed, but key two major aspects. that no reassessment proceedings can be initiated within 1 year from the tax year, because that is the time limit generally available for undertaking the original assessment proceedings. And if any reassessment is required to be done basis the directions of a jar panel or basis the direction of any court order, then there is no requirement to issue a show cause notice under section 148A equivalent, and that would be treated as an information for the purpose of undertaking reassessment, initiating reassessment proceedings to give effect to the directions of those jar or the court orders. And also the limitations under section 150 will not be applicable as such from while initiating reassessment proceedings to give effect to the jar panel directions or the court directions. Again, just a course correction or just in terms of broadening of the areas for undertaking search, where VDA or any undisclosed income under the Black Money Act has also now been considered, including for the person who is having an information about those assets. One of the critical amendment which Dinesh and everybody has spoken is the consolidation of the charitable exemption or non-tax exempt entity. Today it was for education and hospital, it was 1023C. For other charitable, it was section 11 to 13 and registration, which is there. All of these are now consolidated, be it from the perspective of seeking registration for claiming tax exemption, as also the mechanics in terms of the tax exemption or the deduction would be allowed. They have categorized it into two, which is regular income, which would be subject to tax exemption if it is applied for the intended charitable and religious purposes as such. And there is a specified income which is taxable at the rate of 30% for the violation of any conditions which are not for the purpose of charitable purpose as such. Today, there was a ability to accumulate the income which could not be applied in a given year. And there was an option of 1 year from an accrual basis or option of 5 years. They have done away with this dual option, and now tax exemption would only be allowed if income is accumulated over the period of 5 years and to be applied for the intended purpose. One of the aspects which has been there, and especially where a large business house needs to undertake philanthropy activity, where they could donate shares to the charitable institutions, and from that, the various philanthropy activity would have been undertaken. One of the modes of investment which is not permissible is to hold shares of the company. And there was a huge expectation that at least there would be relaxation for donation of the shares of any corporate for the purpose of undertaking the philanthropy activity which is there. In spite of that, relaxation didn't come. And it was a thing that since it's not a permissible mode of investment, only the income arising from that investment should have been subject to taxability and not subject to tax exemption. But now they have mentioned is that if investments are not as per the prescribed mode, the entire amount of the investments will get taxed and not just the income arising from there. There are stringent compliances to be undertaken to continue to maintain tax exemption, including filing of tax return, regular audit and all. And if this is not done, then the entire income would be subject to tax on a net basis, which is there. So I think we discussed about the gamut of specific nuances arising on different aspects of the chargeability, taxability, procedural aspects, as also in terms of the reassessment proceedings which were there. And now, in terms of the repeals and semis, in terms of how the situations, the circumstances, or the proceedings which are being undertaken under the current income tax provision, how it will impact the moment we shift into the new income tax bill once it is enacted. It has been clarified that all proceedings to be undertaken, assessment proceedings, revision proceedings, penal proceedings, for tax years prior to 25-26, means up to 24-25, would be undertaken basis the existing provisions of the Act. And the new assessment proceedings would be applicable only for the tax years commencing from 25-26. Any directions, instructions, notifications issued under the current law would be applicable under the new law, so far as they are not in contradictory to any provisions of the income tax bill. Same way, the ability to carry forward the losses or tax holiday or any option which has been undertaken that will continue to be operating even under the new bill, so far as and that would be respected as such. If there is any violation of the condition basis of which any specific tax deduction or concession has been undertaken and that violation arises in the new income tax bill, then it is provided that those benefits would be discontinued even though the conditions were satisfied under the earlier law and are not being satisfied under the new law. So by and large, the impact is that whatever has been existence will be continued so far as there is no violation of conditions or so far as there is no inconsistency with the new provisions of the Act.
So I think as far as the repeals and savings is concerned, I think the key element to look out for is, once we have the new law, then whether the transition is smooth enough and all things that were done under the old Act, how they will get recognized under the new law. I believe if we compare the repeals and savings with the 1961 Act, I think the repeals and savings here are much more elaborate and possibly try and cover by and large most of the situations which taxpayers would encounter.
And with that, we conclude our presentation on this and would be happy to take any questions.
Yeah, Abhishek, Umesh, there are some 39 questions. So we'll
How much
take,
time do you have?
we have a lot of time. So
Okay.
yeah, we'll start the questions. The terrific insights from Umesh and Abhishek. I think my reading of the new bill, the time taken will be much less. Now we'll start with Jayesh Ganatra. He asked, can you throw some light on deduction of dividend? Deduction of dividend.
Yeah, I'll take it. So under the present law, if there is dividend received by company A and it is distributing it to its parent company or any of its, then there is no multiple level dividend taxability on upstreaming of those dividend income at the multiple levels. And if a company is under the new regime, those deductions will continue to be allowed as such. But now what they have done that if the company is under the new tax regime, which is under the 22% tax regime, and any receipt of dividend income by it would be subject to tax, even though it is distributing it back to its holding company. So at each stage, there would be taxability of the dividend income if you are claiming 22% tax regime.
Yeah.
Again, I think this is a anomaly and possibly one can hope that it will get corrected, because I think for the new regime for manufacturing companies, this benefit has been retained and therefore there's no reason why this should not get retained for people who have already moved into the new regime.
Okay. Bhavin asks whether companies can continue to claim concessional tax rate currently given in 115 BAB or any new compliance declaration is required.
So there is already a sunset which has hit for the 115 BAB. So the company needs to commence manufacturing production before 31st of March 2024. So if a company has not commenced manufacturing by 2024, but is commencing after 2024, they will not get the benefit of 15% tax regime. But anything which has been commenced prior to 2024 and that option has been exercised, that will continue to be available even post 25-26 based on the repeals and savings provision which has been considered.
Will there be separate income tax rules 2025 as well? If so, will that be revamped substantially is the question, Umesh.
Yeah, I think rules will definitely have to align with the new income tax bill, and therefore one expects that a new set of rules will come through. If you see the fine print, I think a lot of powers which were delegated to CBDT, some of those powers, there have been some changes, and therefore one will have to see how the rule making gets aligned to the new income tax bill.
Yeah. Sanjeev Chaudhary, are there any changes in the penalty and prosecution provisions?
No, there are no changes. It's structurally it remains the same.
Ramita Rati, can you throw some light on any changes in the GAR?
even though structurally and conceptually both are remaining the same.
We'll take a few more. I'm just trying to pass through some of them. This is one on a charitable trust. In case of Chintan Shah, I understand that the investment in contravention of 11.5 will be taxable at 30%. Is there any possibility of cancelling of registration of charitable trusts in such a scenario?
Yes, there is an option to charitable, but then we need to pay an exit tax that will be coming, and it's provided under current section of I think 115 TD. So yes, that can be done, but it will come at a cost of exit tax, which would be payable basis the fair market value of all the assets which would be there.
So this appears to be a very stiff barrier which has been created for charitable institutions, and possibly an area where we should represent to bring it in line with the current law.
Puneet Jindal, ATM is not available. Is it a drafting error?
We addressed that on the dividend. Yeah.
We can take a couple more. In the last 2 minutes, 20 more questions have come, which is why I'm trying to parse through. Abhishek, you want to check which one you'd like to take? This is a good one. Shivanand Pandit asked, do you think there'll be any changes relating to direct tax in budget 26? But before that, Umesh Bhai and Abhishek, there have been Finance Bill 25 has just come. It is pending Parliament's consideration. Assume it will get passed. Have all the Finance Bill 25 provisions, do they find, are they there as is in the income tax bill?
Yeah, by and large, except for one that Abhishek mentioned about
Relocation of the overseas fund to the Indian fund, where the earlier cutoff date was 25, which they extended it into 2030 in the finance bill, but those corresponding changes have not been incorporated under the income tax bill, except for that one.
One question on taxpayer charter from Saurabh Saigal. Does it actually live up to the promise of trust first, scrutinize later?
So even under the current Income Tax Act, there is a reference of adhering to the tax charter. But again, this is through what it would be prescribed by the CBDT, and those specific provisions are continuing. The expectation would have been that they would have codified in terms of what is the expectation under the law itself, as compared to issuing a separate delegated charter which is there. Yes, the expectation is there because it's now codified under the law that they should be adhered to.
There are specific questions from several people whether this change is there, that change is there. So I'll take one of each. Sham Nori, good friend from Hyderabad, from a leading corporate. Any specific changes to existing section 5 and 9? I must confess that even I went to the first to those sections only. They've made it simpler, right? I mean, section 9, which was so litigated in Vodafone, and whether how to read it. I think now with the bullet points coming in, it's been arranged rearranged in a particular.
Yeah, they have rearranged, and whatever explanation is required, they have put it back in a schedule, that you see the conditions that are there as a part of a schedule, but the main provisions are coming in a very, as what you say, they have broken up the sentences into bullet forms for an easy understanding.
Does that change interpretation?
Answer your question, I think by and large, section 5 and section 9 remain more or less in the same form.
And except for that one aspect of royalty, the charge of that, especially if it is paid to the resident and non-resident, only those
again it appears to be an anomaly. Could be set right, because doesn't seem to be intentioned, so seems to be a slip, and therefore hopefully it will be corrected.
So Umesh, just to get it straight, rearranging section 9 the way they have, instead of one long-winded sentence, it's now broken into bullet point. It doesn't change the way you see the section.
No.
No,
Or you think that's still up in the air? Maybe we'll find out later.
No, I mean, surely, when a new law gets promulgated, there'll be a lot of fine print analysis that will be required, and I think this is still work in progress in terms of a very deep dive fine print analysis. But I think if you see broadly, the template seems to be almost same.
Rajesh asks, is there any change in residency rules for non-resident?
No.
No, not really. Whether the composition of select committee will be made known to the public? Absolutely yes. Parliament works in a transparent manner. The select committee composition will absolutely be made public.
I think the only point is that, given as what Dinesh said, the time horizon available for the select committee to chew up all the suggestions is not very long, and therefore, how much the select committee will actually be able to do, one can remain optimistic, but I think the reality is already set in stone.
Yeah. Amit, this is a very interesting question. Can we file appeal to High Court or tribunal is final? No. You can file an appeal to High Court, of course, right? 260A has been retained, I'm assuming.
Yeah.
Any change there in 260A, or is it just as is
No,
substantial?
as is. I think the best part about this law is that, because they have not tinkered with, by and large, they have not tinkered, and therefore continuity, I think, which is the biggest worry. I think whenever a new law comes in, I think what we've seen as tax advisors, that in the garb of simplification, the law gets complicated. But hopefully this is not how this die seems to have been cast, and therefore one is hopeful that continuity will remain, and one can be hopeful of some more progressive changes in terms of miles to go.
And today, obviously, the sections which are there, the reference, it's like implanted in our brain. But as we read the new law and things get settled, I think it gives more better reading as compared to the current.
Makaran, my good friend from Pune, is asking, refund claim only within original return filing. Is it a stricter provision?
It is a strict and a harsh provision, and therefore one really will need to understand whether this is how the government intends this to happen, and if this is what we will face finally, then I think there could be a lot of angst which taxpayers will undergo.
Umesh, I've got 33 new questions. It will be difficult. We need 6 hours to go through them. I'll take 2 or 3 more. Umesh,
Yep.
Abhishek,
Yes,
2 or
yes.
3 more. Any significant change in tax audit reporting, Gorgi?
So this will come as in the rules, all the forms to be notified as such, which would be a separate notification. So one needs to wait for that to come. But in terms of the provisions which are there, structurally also remains the same.
Atul Gandhi has this question. Many items in new law have been shifted to schedule. What are the implications with regard to the power to tweak it? Does it make it simpler?
No, I think what seems to be that, rather than having long-winded exemption provisions, I think moving them into schedule makes it much more easier, because I think when you look at the tables, they have in some cases set conditions to be complied with, to whom the benefit is available, and therefore again, if you see from a template point of view, this is a good template. But because these are all codified under the new income tax bill, which will become an act, therefore any new inclusions or exclusions will have to be through the parliament.
And it's one act, which schedule is also included within it. So any changes needs to be through parliamentary action.
Question, any change in buyback tax provisions? Not really, right?
Nothing
yeah.
major.
Removal of the term nil withholding tax. Nil withholding tax rates may lead to officer denying nil rate at all. Would that be the intention?
I think they have still maintained the term to apply for a lower withholding tax, and lower withholding tax could mean nil as well. So maybe to avoid duplication, they would have removed it, and the intention should not have been that it would not be given at all.
Just trying one or two more. I'll take this one and then we'll possibly close it. Any clarity on tax deductibility of intangible assets other than goodwill in the new bill?
So they have already brought in an amendment in terms of determining the cost of intangibles, which if it is a self-generated, that would be nil as such. But per se, on the allowability of the depreciation, if it is an acquired intangible asset, there is no change on that.
Also, from a amalgamation point of view, I think by and large, the same provisions continue, and therefore the fight, if at all, will continue as it is.
Yeah, Aishwarya has put up this question twice, so therefore I'll take this as the last one. Concept of arithmetic mean for ALP determination has been deleted. What is proposed in place of it?
So they have provided that they will come out with the manner in which of computing if there are multiple comparables. So one needs to see what will come in the rules or the framework.
The total number of questions has exceeded 100. I have not, this is the first for us as well. So we will come back. This is not the last webinar. We'll come back. Impossible to take all the questions today. But many thanks for attending this webinar, for the record attendance, for a patient hearing. And I'm seeing a lot of messages thanking our speakers for a very erudite presentation. Umesh bhai, Abhishek, thanks so much. I think we all are, better off in terms of our knowledge and insights. Thanks to the insights you all have shared. And thanks everyone for attending this webinar. Happy Valentine's Day to everyone. Let's all fall in love together with the new income tax bill 2025. I have no doubt whatsoever that this bill will be enacted, maybe with some changes depending on the select committee's recommendations. But we are all set for a new income tax code. Once it gets Parliament's nod, Lok Sabha's nod in the monsoon session. We are just getting started at TaxSutra with a coverage of Income Tax Bill 2025. Stay tuned for roadblock coverage as a lot more awaits as we keep chewing these provisions. And as Abhishek said, every time we read a new law, something new will strike us. That's the ingenuity of great tax professionals. And we at TaxSutra will be covering this bill, every bit of its way and the journey towards enactment. Thank you, everyone. Thanks to everyone at Dhruva Advisors for partnering us for this webinar. Thank you. Have a great day ahead.
Thank you, TaxSutra, and thank you, participants.